Last year, the Bank of England made a very gloomy prediction, a deep and prolonged recession. That turned out to be wrong. The UK narrowly avoided a recession, but the downside is that the Bank of England were also wrong about their inflation predictions. The UK has now one of the highest rates of inflation in the developed world, and this is causing the Bank of England to belatedly increase interest rates in a bid to cool inflation. But this rapid rise in mortgage rates risks causing widespread economic pain. So why is the economy on a knife edge? Why is inflation so high? And how likely is a deep recession in the UK? In the past 2 years, UK inflation has persistently exceeded the Bank of England's forecasts. Now, inflation was initially due to rising energy and gas prices, but this temporary cost-push inflation, pushing up nominal wages and also core inflation, this shows services inflation, and it's important because it excludes import prices, food and energy. And it's a sign that the UK is generating its own domestically induced inflation. And this is what is worrying markets and the Bank of England. Last month, the headline rate of inflation actually dropped, but the fall was much less than expected, and it caused markets to expect much higher interest rates. And many banks have been withdrawing fixed rate mortgage deals, and we've seen interest rates go up. And the rise in interest rates that we are seeing will have a really big effect on the economy, especially as over 1 million homeowners will soon remortgage to a much higher rate. In 2021, fixed rate mortgages were as low as 2%. Now if they rise to 6%, that will cause a very large jump in mortgage costs. Even on a modest £200,000 mortgage, the average homeowner could face an extra £440 a month. Very difficult in a time of falling real wages. Now historically, a headline rate of 5% may not sound very much. The Daily Telegraph today runs a piece on how some of its older readers survived interest rates of 15% in the 1970s. But these headline interest rates are actually misleading. House prices were much lower in the 1970s because now house price to income ratios are so high at record levels. A small increase in interest rates has a very significant effect. This graph shows the effective interest rate and why a headline rate of 15% in 1979 was equivalent to closer to 3% now. But more importantly, it shows that the effective interest rate is getting close to those peaks in the early 90s, which caused a deep recession and big house price crash. Now, usually with rising interest rates, there is a time lag of around 18 months before their effect is fully felt. Interest rates started rising last year, so it will only be in 2024 that their impact on reducing spending will be fully felt on the economy. Interest rates have a big time lag because so many people are on fixed rate mortgage deals, and it takes time for banks and homeowners to adjust to the new reality. Another problem with interest rates is that they are a very imperfect tool for bringing down inflation. We've had 12 rate increases, and it's done very little to reduce inflation. The UK's inflation is not because the economy is booming, like say in the late 1980s, the Lawson boom, but because we all have all kinds of new supply constraints with rising food and energy prices. Also, the labour market is very tight. Vacancies reached a record 1.3 million in 2022. This means it's hard for firms to fill job vacancies. The result is that firms are facing higher costs and putting upward pressure on nominal wages. The labour market has also been hit by Brexit, with some firms struggling to fill vacancies previously filled by EU migrants, such as in the entertainment industry or the farming sector. Secondly, Brexit has also contributed to difficulties to importing cheap food. Earlier in the year, the UK had food shortages, which was not seen elsewhere on the continent. Another big problem for the UK is that we've seen a very significant rise in long-term sickness, which has caused a fall in labour market participation. This explains why the labour market is tight, yet economic growth is also very low. Wages are not being pushed higher by red-hot demand, but by a shortage of workers and high vacancies. And the problem is that increasing interest rates doesn't begin to tackle these underlying supply constraints. And therefore, to bring inflation down to a target of 2% may require very significant economic pain, which will almost certainly cause some kind of recession. A few weeks ago, Jeremy Hunt, the Chancellor, said he would be happy to have a recession to bring down inflation. But that's just the problem. With inflation so stubborn, it may well require a recession to bring it back down to target. The second problem of increasing interest rates is that it affects different people in different ways. Some actually benefit from higher interest rates. Savers will see better returns and increased interest income. Older people who have paid off their mortgage will be blissfully unaware of higher interest rates. The point is that to bring inflation down through higher interest rates is likely to be a painful process, but this will be focused on homeowners, mortgage holders. And also, it's probably bad news for renters. Renters have already been facing record rises in rents and difficulty in finding available property. But higher interest rates will probably be passed on to them in some form. It's encouraging landlords to sell, which is reducing the amount of available supply. And some landlords are trying to pass the interest rate rises on to renters. The increased interest rates will also put pressure on house prices. Last year, prices reached this record level of historical unaffordability, and the combination of overvalued prices and rising mortgage rates is a recipe for falling prices. Moody's predict a 10% fall, others say it could be a crash of up to a 35% fall. But the important thing is that falling house prices will, at least in the short term, cause lower economic growth. In the past decade, rising house prices have helped underpin household confidence and a source of equity withdrawal. But when house prices fall, we get this negative wealth effect, a loss of confidence, the spectre of negative equity, and it will also hurt banks and building societies who might cut back on lending. The last two periods of house price falls, 1991 and 2009, both coincided with a deep recession. A recession contributes to falling house prices, but falling house prices also fuel recessionary pressures. It's an unwelcome combination. So not only do we have the biggest interest rate squeeze since the early 90s, but there are also many other unfavourable factors. Recent tax changes led to the highest tax burden as a share of GDP on record. High inflation and rising nominal wages is actually causing many more workers to move into the higher tax bracket of 40%. So it'll be a shock when workers get some nominal wage rise, but you realise that a lot of this extra income is now taxed at 40% rather than 20%. Now, another problem for the UK economy is that underlying long-term economic growth has been very weak since 2009. And this weak economic growth means that even a small headwind like higher interest rates can push the economy into recession. There's little resilience. This shows the UK productivity growth since 2009. And you can see that the growth rate really slowed down quite sharply after the financial crisis and hasn't recovered. This also shows the lost output, with growth being far below the past trend rate of growth. The impact of Brexit, uncertainty, costs to trade, poor productivity have all led to low business investment, which is crucial for the long-term economic growth. And although there's been some recovery since COVID, it is still below the 2020 peak, which is kind of unprecedented. And the new era of higher interest rates will also hit business investment as the cost of borrowing increases for them too. Now, given that the Bank of England are tightening monetary policy with higher interest rates likely to be here for a while, one option to save the economy is for the government to provide some kind of fiscal stimulus. For example, the tax cuts Conservative MPs long for. And there's already been some noise about providing help for homeowners who are facing higher mortgage costs. However, the problem is that the room for fiscal manoeuvre is limited by rising public sector debt and also rising interest rate costs for government borrowing. Also, the impact of last September's disastrous mini budget, where bond yields soared, will be fresh in the government's mind. It's a reminder that uncosted tax cuts could be problematic in an era of rising interest rates and low economic growth. But also, even a small cut in income tax, which may well happen soon, would still be insufficient to offset the impact of rising mortgage rates. Also, across the globe, there are signs of a global economic slowdown, which will hurt the UK economy, because despite Brexit, the UK is still a relatively open economy, reliant on trade and the fortunes of other economies. The usually strong German economy contracted 0.5% in the first quarter of 2023. This was mainly due to a decline in consumer spending because of inflation. And despite this downturn in the German economy, the ECB recently increased interest rates too to tackle stubborn EU inflation. Even the Chinese economy is struggling due to a bust in the property sector, and perhaps of more concern, the slowdown in export growth, hinting at weak global demand. So at the moment, it's really quite easy to be pessimistic about the state of the UK economy. The rise in interest rates and the prospect of falling house prices are very real problems happening right now, and the impact will only grow throughout the year as the impact of interest rates have a greater effect. Now, I tried to end these videos looking at all the negative news to try to look for some rays of light, look for some optimism. And it's not clutching at straws, but it's definitely hard to think of too much positive news at the moment. I guess one thing is that economies do have a habit of sometimes being more resilient than you might expect. You know, it's interesting that the economy avoided recession despite the bank's forecasts. Also, on an optimistic note, we could hope that inflation will really fall this year as petrol prices go down and the government price guarantee will start to lead to lower gas prices. And if inflation does fall, as it should do, then this will reduce the pressure on higher interest rates. But the damage may already have been done, because even if interest rates peak at say 5.5%, the impact of these rate rises will be felt for quite a long time, even if perhaps next year interest rates even come down. So overall, it is a pretty gloomy situation. There's little room for manoeuvre. And we have two problems really at the same time. We've got the impact on demand from higher interest rates and falling real wages. But secondly, we've got this more long-term problem of low productivity growth, low investment and low long-term trend rate of growth. And really that's not going to be helped by these short-term problems. In fact, it's only going to make it worse. So the outlook's pretty bleak, but let's hope that we get a bit of more positive news in the months to come and things don't turn out to be quite as bad as it's looking like at the moment. If you like this video, do check this one out on falling house prices. It goes into more detail about why prices are falling and how far they might fall in the future.